Welcome, folks, to another video from Blue Sky Trading, where we try to make sense of the market for you. Because we have so much information to share this week, we decided to break this video up into two videos. For the first video, we're going to go over the market in general, review the current risk factors, look at the S&P and the Qs, and run through the various sectors looking at any possible setups. The second video will be a more in-depth review of specific stock that we are following in those sectors that are holding up better. And just as a reminder, if you enjoy this video, please remember to like and subscribe to our channel so that we can continue making this great content for you guys.
All right, let's get right into it. So, as everyone knows, it was another down week last week. Not only was it a down week, but many stocks went down all the way to new lows. So we're still in an oversold condition. We were in an oversold condition to start the week last week and just became more oversold as the week went on. But there's nothing to say we can't get even more oversold before we get the next bounce. Similarly, the fear greed index, we're still in the extreme fear category. But again, there's nothing to say we can't get even more extreme fear before we get some type of bounce or some type of relief rally.
That's important to note. While it's good to be aware of these sentiment indicators, you can't trade off of them. They only give you the overall market sentiment and can indicate the possibility of a reversal coming soon. But you need to focus on the charts. That's key, guys. Focus on the charts to confirm a reversal before going long.
Exactly. So let's get right to that. Let's start off with the VIX and the US dollar. So I'll bring up the VIX first. So look, both are still in an uptrend. Until we get some type of breakdown in the VIX and the dollar, it's going to be a major headwind for stocks and any risk assets. If we look at the VIX, ever since the beginning of this year, it's been in this kind of sideways to upward channel. Continues to make higher lows and seems to, at least for now, be peaking out around that 35.50 level. And we're pretty much right at that top now. Last week on Wednesday, we had this bearish engulfing candle, which gave some kind of hope that we might see a breakdown in the VIX and a rally in stocks. Thursday was just an inside day, so not really significant. And then Friday, it looked like we were going to have a breakdown. VIX actually did get a fair bit below the 80 EMA, but throughout the day it started to rise again, went up almost to Thursday's high, and then ended up pulling back at the end of the day, pretty much to break even for the day. So it doesn't really tell us a whole lot other than that we get an indecisive doji candle on Friday. Really still doesn't tell us the direction where we're going, if we're going to break out to new highs, which in that case would most likely be a pretty severe sell-off in stocks. Or if the VIX is going to break down, stay below this 80 EMA, or ideally even below the 21 EMA, and give us some kind of relief rally in stocks. Similarly, if I bring up US dollar, still in an uptrend, still in a very strong uptrend, other than that we did get a couple days last week of red candles, brought it down below the 8 EMA, had two nice days actually, two days in a row of selling in the US dollar. And then on Friday, a slight bounce, but actually closed right at the 8 EMA. So this one actually looks a little bit better than the VIX as far as a possibility of a breakdown. And we'll just have to watch these next week and see where they go. All right, so let's look at the SPY and the Qs now. First, I'll bring up the SPY. So the SPY making a new low on Friday. Obviously not good for the overall market. We were hoping that this low from June would hold. And it did for several days. You can see that the SPY bounced off of that support level 1, 2, 3, 4, 5 times, 5 days in a row. Now, kind of like banging on a glass window, the more times you hit support, the more likely it is to eventually break through it. And that finally happened on Friday. So on Friday, we closed decisively below those June lows and created a new low. And I mean, now really there's no telling where the selling will stop in the SPY. Similarly, on the Qs, also closed Friday. It seemed to hold up a little bit better at the beginning of the week. Wasn't quite down at the support level, but on Friday finally broke through and also closed right below that June low support level. And actually on the Qs, if we look at a weekly chart for the Qs, we can see that we've even closed below the 200-week moving average, which I think if we compare to the SPY, right, the SPY is right at its average, at its 200-day moving average, while the Qs closed below it, showing even more weakness than the overall market.
And that's still consistent with what's been happening all year. The tech stocks were hit first and have fallen the most during this bear market. So,
right, and something that I noticed on Friday that really caught my attention. We bring up the chart IWM. So this chart is the small caps. Basically, it tracks the Russell 2000. So it's all the small cap stocks. You would think in an environment where we have rising interest rates, high inflation, that the small cap stocks would get hit harder than the large cap. But interestingly enough, that's not happening. And the small cap stocks, I mean, typically they don't have as good balance sheets. They have bigger loans. They need additional financing. They don't have as much growth or profit margins as the large cap stocks do. So you would think that the rising interest rates would be hurting them more than the large cap growth stocks. But for whatever reason, that doesn't seem to be the case. They're actually holding up above their June lows and haven't broken that level yet.
That is really interesting. Just more reason to avoid tech and other high growth or large cap stocks.
Yep, that's right. So let's run through the ETFs now and take a look at what's doing well and what's not. So let's use the weekly charts for this. It gives a little better picture, a better indication of what's going on. So if we start with the ARK, I mean, you don't want to be in this. There's no reason to be buying this. It's near its 52-week low. It's below all the moving averages. Doesn't matter if you look at a daily chart or a weekly chart. It's a chart with a lot of pain in it, so just stay away from this one.
Yeah, there's no reason to be long in this chart, that's for sure. So next up, let's look at SIXI. Looks not as bad as the tech, but made a new low last week.
Yeah, exactly. I mean, I wouldn't be trading this one, but just don't lose track of it yet. It has held up to some extent, so watch it to see if it can stabilize and start making some higher lows. But unless if it does that, I wouldn't touch it. Just watch it for now. On the Smh Semiconductor Etf, pretty much the same thing. Not looking good right now. It's below its 200-week moving average. I'd say stay away from this one also, unless if it can quickly regain that 200-week and bounce from there. But if it continues to close below the 200-week, I would just stay away from it. Take a look at TAN, which is the solar ETF. This one's actually holding up really well. It's right around its weekly moving averages, showing a lot of relative strength compared to the rest of the market, compared to the other indexes. And for now, at least, it's continuing to make higher lows. So this is definitely one to watch.
Next up, let's look at XBI. Big pullback. Lots of pain in this chart, but potentially it's making a higher low. I'd watch for a confirmation move up.
XLF, which is the financials. This one was holding up pretty well until last week when it broke through the 200-week moving average and also made a lower low. We want to watch this one to see if it can regain that level. Ideally, if it can regain it quickly, like next week. Otherwise, I'd stay away from this one also, as long as it's below that 200-week.
Next up, let's look at XLE. This is the best chart so far, holding above 50-week moving average and still making higher lows. So this is looking good.
All right, next up, let's look at XHB. These are the home builders. These are actually holding up surprisingly well. Again, you would think with high mortgage rates, you'd expect the home builders to be down more than what they actually are. But currently, they're holding just barely under that 200-week moving average. I would keep an eye on this one, see if we can confirm that higher low, and then move back up above the 200-week average. As long as it maintains this higher low and moves back up, I think this is one that's worth watching. Okay, we can take a look at XME also. This one, it's quite volatile. However, it does seem to be holding up for now. At the moment, I'd say it's consolidating sideways. It looks like it's holding support at around that 39.50 level, right around here. So I think as long as it can hold that level and start to bounce from here, again, I think this is one that's worth watching.
So now let's take a look at XRT. Yeah, I mean, you got to stay away from this one. Making new lows and well below the 200-week moving average.
Yep, that's right. I wouldn't get involved in this one, at least not for now. So, going through the market in this way, it makes it pretty clear on what's holding up better and what isn't. Obviously, as you saw, the best in the market right now is the energy, that's both oil, gas, and renewables, and possibly the metals and minings, if it can stay above support. The biotech and home builders, maybe those is a possibility to watch, but I'd say right now, none of those are buys, right here, right now. You really need to watch for a move to confirm that buyers are stepping in. In this type of market, the entries and risk management is just so important. Otherwise, you'll get chopped up. So we'll be doing a second video this weekend to focus in on some more stocks that are in these sectors that we just reviewed, the ones that are holding up the best. So look for that link in the video.
And if you enjoyed this video, please hit that like button and subscribe to the channel so that we can continue to make great content for you guys.